Hello, and welcome to Better Investing. Today we are going to look at what PE ratio is, what does it mean, how do we calculate it, and what can we use it for? PE stands for price to earning. The PE is a ratio for valuing a company compared to its earning. The PE ratios is used by investors in analytics to determine the relative value of the company. It can be used against its own historical record or against other companies to see if the price is overvalued or undervalued. To calculate the PE ratio, you divide market value per share to earnings per share. So simply divide the stock price to the earning per share, also called EPS. To find the EPS, you can simply divide the company's profit to the numbers of shares outstanding. But remember, it is multiple variations of EPS. Two common types of EPS used to measure the PE, forward PE and trailing PE. Forward PE is when you use future earning guidance. Then you'll get the estimated price to earning that can help to get a clearer picture of how the company will do in the future. The trailing PE is based on using the last 12 months of earning to set how the company are doing or has done. Let's take an example to calculate the PE ratio for a random company. The company's stock price closed at 10. The company's profit for the fiscal year was 10,000, and its number of shares outstanding was 50,000. Its EPS can be calculated as 10,000 divided by 50,000, that equals 2. The PE ratio for the company is therefore 10 divided by 2, that equals 5. So, what does a PE ratio at 5 mean? Simply put, a PE ratio of 5 would mean that the current market value of the company is equal to 5 times its annual earnings. In other words, if you were to hypothetically buy 100% of the company's shares, it would take 5 years for you to earn back your initial investment through the company's ongoing profits. The question of what is a good or bad price-to-earnings ratio will necessarily depend on the industry in which the company is operating. Some industries will have higher average price-to-earnings ratios, while others will have lower ratios. For example, as of January 2020, publicly traded U.S. coal companies had an average PE ratio of only about 7, compared to more than 60 for software companies. If you want to get a general idea of whether a particular PE ratio is high or low, you can compare it to the average PE of the competitors within its industry. Many investors will say that it is better to buy shares in companies with a lower PE, because this means you are paying less for every dollar of earnings that you receive. In that sense, a lower PE is like a lower price tag, making it attractive to investors looking for a bargain. In practice, however, it is important to understand the reasons behind a company's PE. For instance, if a company has a low PE because their business model is fundamentally in decline, then the apparent bargain might be an illusion. In general, a high PE suggests that investors are expecting higher earnings growth in the future compared to companies with a lower PE. A low PE can indicate either that a company may currently be undervalued or that the company is doing exceptionally well relative to its past trends. When a company has no earnings or is posting losses, in both cases PE will be expressed as not applicable, though it is possible to calculate a negative PE. This is not the common convention. The price-earnings ratio, PE ratio, relates a company's share price to its earnings per share. A high PE ratio could mean that a company's stock is overvalued, or else that investors are expecting high growth rates in the future. A low PE ratio could mean that a company's stock is undervalued, or else that investors are not expecting high growth rates in the future, or that the company is doing exceptionally well relative to its past trends. Companies that have no earnings or that are losing money do not have a PE ratio, since there is nothing to put in the denominator. Two kinds of PE ratios: forward and trailing PE. Be sure of which you are using and what purpose they have. Make sure when looking at PE ratio to check the historical trends in the company and other companies in the industry for comparison. In some industries the normal may be 10 and in another it is 30. Thanks for watching. Please like and subscribe for more content.